Hi there, welcome to Kneppy Invest. In today's video, I'm going to be talking about a company I actually do quite like a bit. And that company is Enero, ticker code EGG. This company is showing really good to great growth over the past few years. And when you look at the valuation, there is potential that the market is completely missing the Enero story right now. So in this video, we'll be looking at Enero's financial year 22 results, looking at valuation, and also looking at the revenue growth over the past few years. Now, right now, I'm still going through a lot of the financial year 22 results, up to about August the 22nd right now. So only about 6 or 7 days to go, but a lot of companies did release their financial year results during the last week in August. But I do have a list, or developing a list of companies I do want to talk about or do a video on, and some of these companies I will be looking at in the next few weeks include Xtech, Energy One, CSL, Data3, and Lindsay Australia. If you do have a company you'd love me to look at, just leave that company in the comment section of this video, and then I'll have a look and see if I'd like to do that company. But preferably, I like that company to be profitable and also a company that has been growing over the past few years. Now on to Enero, and the first question I have to ask myself when it comes to a company, any company, is what the quality of that company is. Is it a high quality company or is it a low quality company? Because the way I treat high quality companies is a little bit different than the way I treat low quality companies. So for high quality companies, it all comes down to value. If I see good value, I don't care about the trend and the sentiment. But if it's a low quality company, it's all about sentiment and the share price trend. I don't really care all that much about value. Now, a few years ago, I probably would have defined Enero Group as a low quality company, because if you take a look at their history up until about 2018-19, this was not a growth company, and there were a lot of questions in regards to Enero. At one point in time, they weren't called Enero, they were called something else. Then they changed their name to Enero. But it seems like over the past about 3 or so years, this company has hit a very important inflection point or a pivot point, and this company has started to show signs of being a high quality company. So if it is a high quality company, and not absolutely convinced of that just yet, it all comes down to value. So what does Enero actually do? So this company is all about marketing and communication services. So for instance, some of their principal activities include integrated marketing and communication services, including strategy, market research and insights, advertising, public relations, communications planning, design, events management, direct marketing, and programmatic media. I'm just looking at that annual report right now. They just mentioned some of the things they are focusing on right now. So they're focusing on new business conversion, organic revenue growth to increase net revenue. Additionally, building scale and presence in the UK, in USA markets to seek a more evenly weighted geographic contribution from net revenue and operating EBITDA. In fact, we'll have a look at their geographic distribution of their revenue later in the video. And they've also talking about continue to assess acquisition and capital deployment opportunities as they rise to complement the key operating business brands. So quite a few things to like about this company. The very fact that they are seeking some scale, looking to increase their business overseas, and they're also looking at possible acquisitions. Now, historically, and research has shown this, that companies that do continually make acquisitions, eventually some of those acquisitions will fail. So just because companies keep making acquisitions, it doesn't mean that's going to be successful for the business in the long term. I do prefer organic growth over growth that's through acquisitions. So that is something to keep an eye on. So if they do make really good strategic acquisitions, that's something different. But just making acquisitions for the sake of acquisitions is not the best business model, in my opinion. Now, this is the long-term chart for Enero, and sometimes you can judge whether a company is high quality or low quality just by looking at the long-term chart. So this is the weekly chart for Enero going back to 2012. The share price back then was as low as about 30 cents, even 20 cents at one point in time. But the share price has been climbing ever since 2012, 2013. And in fact, the share price is in a well-defined uptrend just by looking at the weekly chart. Whenever you see a nice dip in the share price, that is the time to take a position. So during the COVID-19 financial panic, the share price actually dropped from about $2 all the way down to less than 80 cents. And recently, we have seen another dip in the share price. In fact, the share price has dropped from $4 to about $2.60. And right now, the share price is hovering around $3. So the next more important thing is just to look at the valuation. Is the valuation of this company high? Does the market absolutely love this company and is putting a premium to Enero right now? Or is there really good value in Enero at this point in time? So we'll look at that valuation of this company later in the video. Now onto the financial year 22 results for Enero. First thing we're going to look at is the valuation. So the share price of $3.07, and the share price right now, as I'm talking, is about $3.01. So share price has pulled back a little bit since I set up this video, but it's $3.07. The market cap of Enero is $282 million, which doesn't seem too high. Now onto revenue, $522 million of revenue, and revenue has been climbing significantly over the past few years for this company. We'll look at the revenue growth for the company in the next few slides. Profit, $25.4 million. So this company is profitable. And again, profit is growing. Operating cash flow, $30.2 million. Now, this is not the operating cash flow that the company is reporting, because what I've done is I've minused or decreased the leases and the non-controlling entity dividends from their operating cash flow. But that still gives me a $30.2 million. Earnings per share, 28.2 cents. So straight away, by comparing earnings per share of 28.2 cents to the market, 282 million, gives us a P ratio of Enero of exactly 10, which doesn't seem too high for a company that is growing. So at this point in time, there is a lot of wariness in the market in regards to Enero. The market is not giving any sort of premium to this company. So I don't know why that is. There could be some questions about future growth for Enero moving forward. The company has been growing in the past, and even their outlook looks fairly bullish. So at this point in time, I am interested in Enero just because of the valuation. But I want to just stand back a little bit, try to understand why the market might be wary about this company at this point in time. So in this video, we're looking at the revenue growth for Enero. Now, remember earlier I said, if this was 2018 or 19 and I was looking at Enero, I probably would have dismissed this company straight away, because this is the revenue for Enero going back to 2012. And from 2012 all the way through to 2018, revenue for this company was actually dropping. Now, I took a quick look at the history of this company. And back in 2012, they were under a different name. They might have had a slightly different business model. But things have changed over the past 4 or 5 years. Revenue has grown from $163.5 million in 2018 to $522 million in 2022. And this revenue growth has been quite significant in the past 3 to 5 years. Not only that, the operating margins for this company has climbed quite considerably over the past few years, and it continues to grow every single year. So it's gone from single digits up until 2020, up to 11.7% in 2022. So not only is revenue growing, but also operating margins and margins of this company are growing as well. So you've got the double whammy. So that's another reason to get excited about this company. And if they can continue to grow like they have shown in the past few years, definitely with a P ratio of 10, this company does look quite undervalued at this point in time. Now onto results by geography. And when you look at the results by geography and the growth this company has experienced in USA, it's understandable why they want to increase their presence in USA and UK and Europe. And in this particular slide, we're looking at the net revenue and EBITDA. Net revenue is not gross revenue, so overall revenue. This is similar to gross profit, maybe not similar, identical to gross profit. So look at net revenue as gross profit. And we have seen, or this company has seen, significant growth in gross profit and operating EBITDA in the United States. In fact, net revenue has grown at 46.5% from $60 million to $88 million, and operating EBITDA has grown 59% from $32 million to $51 million. In Australia, fairly anemic growth. Gross profit has only grown 5.7% and EBITDA only 1.5%. So maybe you could argue that this company has reached maturity in Australia, and that's why they want to expand overseas. And even in UK and Europe, the growth in net revenue or gross profit, only 3.1%, but operating EBITDA has grown there at 5.4%. So I definitely can understand why this company wants to expand their presence presence in the United States, because the growth this company has experienced shows me they should be focusing on that geography at this point in time. Now onto the company's cash flow statement. And usually when I open up a financial statement, first thing I would look for is just the revenue growth. Also probably take a quick look at gross profit and gross margins. But then I go straight to the consolidated statement of cash flows, because I like to look at the cash flows and then work my way back, go to the balance sheet and then the profit and loss statement. So receipts to customers in financial year 2022, 524 million, and the operating cash flow for the overall business was $48.8 million. But the story doesn't end there. You've also got to decrease any sort of dividends paid to non-controlling interest in controlled entities. That was $12.9 million in financial year 22. Also like to decrease payments of lease liabilities, which is rent, and that was $5.7 million for financial year 22. So that's how I get from an operating cash flow that they reported of $48.8 million to what I reported or recorded or calculated, which was just over $30 million. So a little bit of difference between those two numbers, but I prefer the operating cash flow that I reported because it gives a better sense of how Enero has performed in financial year 22. The other thing you've got to take into account is changes in working capital. There wasn't any significant changes in working capital, if I remember, for Enero from financial year 21 to financial year 22. One of the most exciting things to read in any sort of financial year results, or maybe even half-year results, is any sort of trading update or any sort of guidance a company does give. And in some ways, sometimes this is what can drive the share price of a company higher or lower. If they give out a really good update that exceeds the market's expectations, you might see the share price of a company climb a fair bit. And the opposite end of the spectrum, if a company gives out a fairly negative trading update or any sort of negative guidance, that's when you might see the share price of a company drop a fair bit. So it's not always about the results for financial year 22. It's also about any sort of trading update or guidance a company gives. And this was pretty good trading update from Enero. For instance, the first 5 weeks of financial year 23 has seen a continuation of the company's growth trajectory. Now, they haven't given any numbers at all in this sort of trading update. That's okay at this point in time, because financial year 23 is still fairly young, and it's going to be hard for most companies to know how they are performing and are expected to perform for the rest of the financial year 23. But at the end of this particular statement, they did mention that Enero is well positioned for organic growth in financial year 23, along with the full year benefit of a couple of acquisitions the company has made. So things are still looking fairly positive for Enero right now, even though the market is a little bit wary of this company right now. And we know that the market is a little bit wary about Enero just by looking at the valuation metrics of this company at this point in time. P ratio 10.9, price to sales ratio 0.54, price to operating cash flow 9.3. The P ratio and the price to operating cash flow seem fairly low for a company that has shown pretty good growth over the past few years. And even the price to operating cash flow, that operating cash flow is a cash flow that I calculated. So if you use the operating cash flow that the company reported, you get that valuation metric to be a little bit lower than it is right now here that I've shown you, which even makes this company seem even more attractively priced at this point in time. And then I did a reverse DCF using the operating cash flow that I calculated, and to justify the current valuation with a market cap of about $280 million, the company has to grow at 0.96% per year over the next 10 years to justify that valuation. Can the company grow at 1% per year to justify the current valuation? So this is one of the reasons why I'm a little bit excited and intrigued by this company right now, because it does look really good to great value at a market cap of $280 million at a share price of $3. Now I'm just going to take a quick look at the daily chart for Enero. So even though I'm more interested in the valuation of the company right now, because I think this is more akin to a high quality company than a low quality company, so valuation is more important than sentiment and the share price trend, I still like to take a look at the chart just to see how the market is viewing the company at this point in time. And during calendar year 2021, there was a fair bit of positive sentiment in this company. Share price was in a well-defined uptrend, but that uptrend really came to an end in the first few months of financial or calendar year 2022. Share price actually reached its high in the first few days of 2022 at $4.20. But the share price has pulled back a fair bit since then. In fact, the low was reached in June, and that low was around about $2.55. We've seen a little bit of a bounce in the share price since then, but no well-defined uptrend in the share price. And if the share price pulls back towards $2.50, that would be that would mean the PE ratio of this company is well below 10. That means price operating cash flow is probably well below 8. And that would mean this company, if they can continue to grow over the next few years, would be obscenely good value at that point in time. That's all I have, looking at Enero and their financial year 22 results, and also focusing on the valuation. This is an intriguing company just because of the valuation and how the market views this company at this point in time. If you have any thoughts, any opinion, any questions about Enero, love to hear them, so leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.